Welcome back, students who are taking financial accounting, and in this series of videos we are covering the assigned homework problems from the digital study guide for chapter 8, the short exercises. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that's a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Okay, so we finished on 13 in the last video, so we're on 14, which is about amortization. On December 1st, MicroApps paid $750,000 to acquire a patent on software. MicroApps expects the patent to have a useful life of 5 years. Journalize the entry to record the purchase of the patent on April 1st, and journalize the entry to record amortization. Okay, so remember, patents are an intangible asset. Right? And when it comes to intangible assets, instead of depreciating like fixed assets, we depreciate, right? Whereas with intangible assets, we amortize. But basically, they're both exactly the same thing. Okay, it's just a matter of, they could have just said, hey, we're going to, we'll depreciate intangible assets. But I think the reason why they use the different terminology is because one is a tangible versus the other one being an intangible. All right, but really, amortization is no different than depreciation. So, and even though it's an intangible, we record things like intangible assets like patents the same exact way that we do any other buying of a fixed asset. There's kind of like no difference between the two. If you learn one, you know the other. The only difference being is we're talking about something in its nature that's a little bit different. Okay, but we treat them in the same way, and we just use different terminology. So from a conceptual point of view, you're doing the same thing. You already know how to do this. Just because it's an intangible asset does not mean you don't know how to do this. And it's the same thing with natural resources. When we get into another problem, we'll probably have one on natural resources. It's the same thing. All right, same idea, same concept. And so let's journalize the purchase of the patent on April 1. So that's the date. What are we getting? We're getting a patent, and for $750,000, and we're crediting our cash, which we pay. So that's $750,000. Okay, so journalize the entry to record amortization on December 31st. So we're buying it on April 1st, and we're amortizing it. We're amortizing it on December 31st. So if this is April 1st, and this is December 1st, how many months is that? Well, all of April. This is May, June, July, August, September, October, November, December 1st. Okay, so that's 1, 2, 3, 4, 5, 6, 7. That's 8, December 31st, sorry. 9. So that's 9 months. Okay. All right, so if we have 750,000 and we're depreciating it over 5 years, all right, so that's 150,000 per year. Okay, and we take the 150,000, we'll multiply it by 9 months over the 12 months, and we end up with 112,500. 150,000 times 9, right? And then whatever that comes out to be. All right, let me do the math. Get my calculator. 150,000 times 9 is 1,350,000. And then we divide that by 12, and we end up with 112,500 per month. Okay. I'm sorry, for the 9-month period, all right? Because it's only 150,000 per year, not per month. So that's for the entire 9-month period. So on December 31st, we're going to debit our amortization expense for 112,500, and we're going to credit our patent for 112,500. Now, this is what was put into the this was the solution that showed up in the solution manual, okay? And I'm going to once again disagree with what's in the textbook there, with what is in the solution manual, okay? Notice that they're taking and they're directly amortizing, they're taking the amortization right out of the patent, okay? Now I'm going to erase some of this up here so we can realize this, so you can see what I'm talking about. Okay, normally for a fixed asset, let's call it a truck, okay, and let's call it 50,000, and then we'd have our accumulated depreciation account, right, for the truck, and whatever that ends up being, let's just say it's 10,000, so our book value ends up being 40,000. But the point I want to make out here is that we use two different accounts. We use a truck account and an accumulated depreciation account. Now for this solution, what they did was they went and they said, okay, we have a patent, which is the same as, you know, booking the truck, right, for 750,000. Okay, but now notice what they did with this journal entry right here. They took the credit right out of the patent account. Okay, and so if we made that journal entry, we would end up decreasing the amount of the patent. So 750,000 minus 112.5. So we'd end up with the balance after we posted that journal entry. The balance, get my pen here. The balance in the patent account would be 637,500. Okay. Now I have an issue with that in that you don't know what the, you know, if you just look at your trial balance, you don't know what the original amount of that patent was. Okay, so I disagree with that, and especially when I had just got done saying that you know, we treat intangible assets the same as we treat them like fixed assets. It's just the same exact concept. So if it was my set of books, I would actually have amortization patent as a general ledger account. It would be a contra account, just the same as the accumulated depreciation would be a contra account to the truck. So I would actually, on my books, I would end up having a patent for 750,000, and then I'd have the amortization of 112.5, okay, which would then give me my book value of 637.5, okay. So again, I'm disagreeing with the solution in that I would not have credited patent. I would have my journal entry would look like this: a debit to amortization expense, and I would have a credit to amortization patent. Now notice that the terminology I'm using here, okay, my amortization, I'd be using the word expense, so I would know that that's going to, you know, an expense account, just the same as I would use depreciation expense, okay, when I'm depreciating, you know, a fixed asset. Because we use accumulated depreciation, all right, I could call this accumulated amortization patent, okay, that's acceptable too, all right. And if that helps you distinguish between the two, That's fine. But the point I'm trying to get at here is that I would actually have a contra account for amortization, okay, and for that patent, and I wouldn't put it against the asset account in and of itself. All right, so I hope you understood that. Pause the video, go back and watch it again, and we'll just move on to the next problem. Okay. Okay, let's see here. Excuse me. Depletion. Okay, get my pen. Come on, pen. So, Bargain Oil, a small Texas oil company, holds huge reserves of oil. Assume that at the end of 2014, Bargain Oil's cost of oil reserves totaling approximately 14.4 million, representing 1.2 million barrels of oil reserves in the ground. Right? Calculate Bargain Oil's depletion expense per barrel of oil. And then 2, suppose Bargain Oil removed 220,000 barrels of oil during 2015 and sold all those barrels during the year. Record Bargain Oil's the depletion expense for 2015. Right, so number one, we need to figure out our depletion expense per barrel of oil. Okay, and this is very, very similar to you doing, units of production. Okay, so it says here they hold reserves of, let's see, 14.4 million, and that represents the cost is 14.4 million, and that represents 1.2 million barrels in the ground. Right, so think about it. Here's the land, here's the oil, right? This oil costs 1.2 million. I'm sorry, there's 1.2 million barrels in the ground. But, here's the guy, and, he's talking to this guy, and he's saying, hey, this is worth 14.4 million, right? What's underneath us here, okay? So the cost per unit is 14.4 million divided by 1.2 million, or $12 per barrel, right? Okay, so if it's $12 per barrel, and we remove 220,000, right? So 220,000 times $12 per barrel gives us 2,640,000. Okay, that's going to be the amount of depletion that's the amount we're going to use for our depletion expense. So to make the journal entry on 12/31, right at the end of 2014, no, what's the depletion? I'm sorry, for 2015. Okay, our depletion expense is going to be 2,640,000, 2,640,000, and our, that's a debit, and we're going to credit our accumulated depletion. Okay, for oil reserves. And that's going to be like 2,640,000. Now, just like I had just gotten done saying, well, how come in exercise 8-14, why didn't we use accumulated amortization for the patent, but yet here they're using the accumulated depletion for the oil reserves. So, I just wanted to point that out, that in the previous exercise, they didn't use the accumulated depletion. They didn't have accumulated amortization account, but here in this particular exercise, they do have an accumulated depletion, which is what I would have on my books. So just as a quick aside for the end of this video, you're going to have your fixed asset, right? Whatever that is, a truck, a computer equipment, furniture, whatever, and then you're going to have accumulated depreciation. For an intangible asset, right, you should have the contra accumulated amortization account. And then for natural resource, you're going to have an accumulated depletion account. Okay, so I mean, sure, I'm just using fixed asset as a generality, and intangible asset as a generality, and natural resource as a generality, but it doesn't matter what those particular items are, whether, like I said, furniture and equipment, or truck or automobile or computer equipment for fixed assets, intangible assets, license, patents, that type of thing. And natural resources being gold, oil, natural gas reserves. It doesn't matter what type of asset it is. Have a separate, have the accumulated depreciation, accumulated amortization, or accumulated depletion account that's associated with that particular asset when you're doing your books. Okay, you don't want to do what they did for the solution for exercise 8-14. Okay, so go ahead and if you didn't understand that, go ahead and watch the videos again. Go back and watch the theory video that covers it a little bit more. And if you still don't understand it, feel free to contact and speak to an instructor. Okay.